Okay, let's dive right into this explainer. Now, as someone who looks at the market through a value investing lens, really hunting for high-quality businesses with durable competitive advantages, the artificial intelligence boom has been, well, it's been tricky. Everyone is completely obsessed with the shiny new chips and the massive software giants. We're all looking at the gold, but today we're completely flipping the script to look at the shovels. We are analyzing Western Digital, a company that has executed one of the most brilliant corporate turnarounds I've seen in a long time. They've essentially positioned themselves as the absolute bedrock of the AI data economy. So let's look under the hood and see if this is a wonderful business at a sensible price.
Right off the bat, you have to look at this staggering number. We're talking about a 280% total return in 2025. And it didn't even stop there. That climb was followed by another 150% surge in early 2026. For a legacy hardware company, those kinds of returns are practically unheard of. I mean, they're running right alongside the likes of NVIDIA. So as value investors, we have to ask, is the market getting ahead of the intrinsic value here, or has something fundamentally shifted in their economic moat?
Well, as it turns out, the moat is being drastically widened by the sheer physics of AI. Think of artificial intelligence like this massive, high-speed data highway. As developers move these models from just training them in a lab to actually deploying them in the real world, what we call inference, the data requirements literally explode. Every single AI task generates data. And guess what? That data absolutely needs a physical home. That glowing highway of data is driving directly into Western Digital's infrastructure.
You know, it's so easy to imagine the cloud as this magical, invisible space, right? But the reality is grounded in heavy metal and silicon. Listen to how CEO Irving Tan frames their competitive advantage here.
All this advanced AI compute creates a tidal wave of data that must be stored cost-efficiently.
That's the key phrase for their moat: cost-efficient persistence. Hard disk drives, or HDDs, are the heavy lifters making the economics of AI actually work.
But to truly capitalize on this, management had to make a massive capital allocation decision. In a brilliant 8-month spinoff, they separated the business. Western Digital became a pure-play AI hard disk drive powerhouse, while they spun off SanDisk to strictly handle flash and NAND memory. This is a classic value unlock strategy. It's a profound repositioning of the entire business model.
And this is where the financial engineering gets really impressive. By splitting the companies, management executed some incredibly smart debt-for-equity swaps, ultimately monetizing their SanDisk shares to slash debt by $3.1 billion. $3.1 billion. That dramatically cleans up the balance sheet. Plus, instead of spreading their capital thin, every single R&D dollar is now laser-focused entirely on the exact HDD infrastructure that hyperscalers are begging for.
Wall Street completely loved this structural change. Why? Because it allowed the company to take all its science, its firmware, its software engineering, and point it at one single target: maximizing HDD capabilities. They essentially eliminated internal competition for resources and turned into a streamlined machine, custom-built for the AI era.
With that new focus came a major strategic pivot that really caught my eye. Instead of doing the typical hardware thing, just building more factories to pump out a higher quantity of physical drives, Western Digital chose to prioritize increasing the storage capacity within each unit. They explicitly committed to density over volume. From a quantitative valuation standpoint, this is huge. It drives up return on invested capital because you're generating more value per unit rather than just flooding the market.
So, how are they actually cramming more data into the exact same physical footprint? By aggressively pushing next-generation recording technologies. We're talking about ultra-advanced methods to pack magnetic bits closer together. They've got their top customers adopting Ultra SMR, they're already testing 40 terabyte drives with 3 clients, and actively qualifying massive 44 terabyte drives with 4 major customers. They are pushing the absolute physical limits of data storage.
And this is not just theoretical R&D. They are executing right now. They recently shipped an astounding 222 exabytes. To put that in perspective, one single exabyte is a billion gigabytes. But here's the true genius of their strategy. While they're shipping vastly more capacity, they simultaneously drop the cost per exabyte by 10%. So customers get more storage for less money, and Western Digital still improves its own bottom line. It's a total win-win.
Let's look at the deep financials, because this is where the thesis proves itself. Revenue leaped a massive 45.5% year over year to over $3.3 billion. Operating income was up 106%, and look at that net income jumping to $3.2 billion. This is exactly what high-quality earnings look like when a focused R&D strategy meets exploding market demand.
Now, this next chart, this is the holy grail for a value investor assessing business quality. Look at this gross margin expansion, going from 40.1% to 50.5% in just 1 year. For a company manufacturing physical hardware, crossing that 50% threshold is a massive indicator of strong pricing power and a highly durable competitive advantage.
And there's absolutely no mystery about who is driving this. The massive cloud providers, the hyperscalers building out these giant AI data centers, now make up a staggering 89% of Western Digital's revenue. The old consumer PC segment is just a tiny slice now. They have completely morphed from the external hard drive on your desk into the literal backbone of the global cloud.
That dominant market position translates into the lifeblood of intrinsic value, free cash flow. They generated an unbelievable $978 million in free cash flow in just the third quarter alone. That's a highly efficient 29% free cash flow margin. They are churning out cash almost as fast as they're storing data.
So what is management doing with all that cash? This is the ultimate test of able and honest management. They've built a net positive cash position of $450 million, and they are massively rewarding shareholders, executing $752 million in stock buybacks in 1 quarter, hiking the dividend by 20%, and returning a total of $2.2 billion since fiscal 2025. This is textbook, A-plus capital allocation.
Because of this flawless execution, analysts are completely recalibrating their valuation models. They see a massive runway here, projecting target prices climbing past $700 by 2030. Now, of course, these models all assume Western Digital can sustain this AI demand and, crucially, protect that beautiful 50% margin profile we just talked about.
But here's the thing that gives this thesis some real margin of safety. This optimism isn't just a guess. Western Digital's high-capacity drives are essentially 100% sold out to AI hyperscalers right now. They have locked in contracts and incredible earnings visibility all the way into 2028 and 2029. That kind of guaranteed future revenue drastically reduces the long-term risk.
But to wrap up this explainer, we always have to look for the downside risk. Western Digital engineered a brilliant comeback to become a pure-play AI infrastructure stock. But that means they are now entirely hitched to the AI wagon. If this AI spending cycle slows down, or if hyperscalers suddenly slash their capital expenditures, how hard will they be hit? Their greatest strength right now is also their single biggest vulnerability. It's a fascinating tightrope walk, and definitely a valuation story we'll be tracking very closely.